Good morning, everybody. This is Kirk Spano, October 18th, 2019, and we are going to cover a lot of territory today. This will be a very important webinar. I am going to sound a couple of alarms, not only on the market in general, but the economy and some stupid things that investors do. So why don't we get started right off the bat? A couple weeks ago, I told you I was working on a quick quarterly preview and game plan. Wanted to add some context right at the beginning. The whole slow growth forever global economy is structural, not cyclical. This is a Larry Summers idea. I actually said it 4 years before he did over at MarketWatch. But the demographics and global debt of the planet, combined with technology offsets that are disinflationary to go along with the deflationary impacts of demographics and debt, are making it very difficult to grow the economy. The traditional cyclical measures that the monetary authorities, the central banks, would take to get us out of short recessions by injecting liquidity and lowering interest rates, and in the last decade, quantitative easing, are starting to have the impact of pushing on a string. You've heard that before. It's finally true. So the problem that we have is the economy is slowing down, but asset prices continue to go up because there is so much liquidity in the system at the long end. At the short end, on the other hand, we have the repo market, which has been seizing up, and the Federal Reserve has had to undergo some measures to keep that from getting worse, pushing up short-term rates, and potentially having an overnight liquidity crisis that could create some major economic problems. And following from those economic problems would probably be severe market consequences. Why did the repo market seize up? The very simple answer is that there's no trust. There's not really a shortage of liquidity. There's plenty of money out there sitting in T-bills, sitting in bank balance sheets, sitting on money market balance sheets. But they don't want to give up those T-bills and lend money overnight for a couple extra basis points because they're not sure that they're going to get paid back. Why would that be? Somebody is not trustworthy. There is a counterparty out there that somebody that actually a great majority of the banks don't trust. Who is it? Hard to know. Have some speculative theories. Probably a bank or two in Europe and maybe a bank or two in China. Of the primary banks around the world, we talk about the American primary banks, whatever there are, 13 of them. I'd have to double check. There are primary banks around the world. They all lend to each other overnight. And if there's banks that can't be trusted from day to day, that's a problem. Combine that with the long-term growth outlook, which is getting slower and slower, and monetary policy is running into some rather large headwinds. I was over at the FA Trader Room this week. I haven't been there a lot, but I intend to get there quite a bit more here in the future. And some of the analysts there are just flat out wrong about what they think is going on with the Fed. One of the questions I was asked is this QE, the Fed buying back Treasury bills to put cash to the banks, give the banks cash for overnight lending? And the answer is no. Quantitative easing was when the central bank, when the Federal Reserve and other central banks bought troubled assets. Right now, they're trying to buy T-bills in return for cash. T-bills are the most liquid, solid investment out there. They're short-term. They're virtually guaranteed. The federal government says they're guaranteed. They haven't welched on that yet. Those are good assets. So you have the Federal Reserve adding liquidity. At the same time, people immediately say, well, that's QE. No, it's overnight money. It's not going to trickle into the stock market. It's not going to continue pushing asset prices up. This is not the QE that we saw in QE 1, 2, 3, and what I have deemed chubby checker, which is the twist that they did by pushing debt further out. So no, what's going on is not QE. It is to fix the repo issue through buying T-bills, thus injecting overnight cash. This money does not trickle into the economy for the most part, except somewhat incidentally preventing banks from tightening up on lending a little bit. There is a problem bank somewhere, or two or three, and they know that, and they're afraid. Counterparty risk. That's what that is. Go to the Wayback Machine 10 years ago. Counterparty risk. Lehman Brothers. AIG. Right? There's fear that there's a large financial institution or two or three that are in really big trouble. Think of that in the context of a slowing economy. The slowing economy can trigger a crisis event. Why? Because an institution that's already on the brink can get pushed over with just a little bit of effort. So some of these folks are saying that what's going on is quantitative easing. They're flat out wrong. They don't know what they're talking about, and they're just glomming onto a narrative, which I've talked to you about over and over again, that narratives matter until they're proven wrong, and then you go over a waterfall. Jeff Miller, smart guy, says, no, this is not QE. They're just trying to smooth the repo market, just like when they dealt with the LIBOR shift. So don't get confused that every time the Federal Reserve injects a little liquidity into the system, that it's quantitative easing and is magically going to push your stock prices up. It's not. And some of these people are glomming onto that. Now, I put out my quarterly outlook over here, and this person seems to believe that we are on QE 4 and 5 is coming. What if the Fed continues with QE 4 and 5, etc.? Doesn't that change your outlook? Well, I gave him the answer. We're not having QE 4 right now. And we're probably not going to get any quantitative easing before the election. There's a number of reasons for that. One, typically the Federal Reserve doesn't like to change monetary policy much the year of the election. That's traditional. Two, everybody hates Trump. Okay, except for the people that love him. So a third of the people that love him, then good for them. But President Trump has virtually no allies. At this point, do you think Chairman Powell cares about any of the bullshit that President Trump has spewing out of his mouth? And I say bullshit because it's the word that President Trump used. Just reflecting it back on him. So what we need to consider is what is really going on and what the perceptions are. So if there's people who think the QE is going on, they might push the stock market up a bit. It's got a little bit of rally. And we will see what goes on in the not too distant future. I'm going to reduce the juice that my computer is using so that nobody gets a fuzzy screen. I have to figure out a way. There we go. So, got rid of some of the juice. I may have to buy a supercomputer. This one's 5 years old. I overbought it when I bought it, but I think it's getting to the end of its useful life. Seems to run the memory a little bit too much. So understand that quantitative easing is not going on. That's an important point. Interestingly, on the IMF blog, they talk about lower for longer. Oh, they just changed that. Global banks may grow more vulnerable to a dollar disruption. The world economy is in a synchronized slowdown. Precarious outlook. If that's not worrying you, then you're a gambler. And I understand gambling because I'm a good one. Not a great one, but I'm a good one. Was playing poker again the other night. I don't normally play during the week, but there was a tournament I wanted to get into. And some guy was talking about how the Fed was about to start more quantitative easing. He didn't know anything he was talking about. So there's a lot of bad narrative out there. A lot of people believing things that just aren't true. If you're not reading the IMF's World Economic Outlook every quarter, I understand because it's longer than hell. What is it this time? 100 pages? 200 pages, yeah. I get it. I do read this, and I try to share it with you as best I can. But this is something that I have put into the new report that I did, and I think it'll help you. The global growth projections around the world are slowing from where they were over the past few years. Now, this looks like, oh, look, up 3.4%. Remember, these numbers were in the 4s and 5s a few years ago. So the trend is down. Global growth is, in fact, weakening. I've added some sheets to the report I sent out to you. If you're not a subscriber, take a free trial, and you get to see this. In fact, I think I have it unlocked on fundamental trends right now anyway on the front page. Global growth is falling. Trade growth is stalling. This is not inconsequential. This is what the tariffs are hitting. Right? New trade measures. Bam, bam. Industrial production falling off a cliff. Look at Germany. Investment growth. Remember what I've said the last several weeks? CEOs are sitting on their wallets. Falling off. Employment growth coming down. Almost everywhere. Look how this turned over in the last year. What have I told you? Employment is the harbinger of bad things to come. Europe's growth. Look where it is. It's hovering around 0 for the last 4 or 5 years. They can't get growth anymore. Lower highs. One handles was common on growth. The ISM report fell off a cliff. Quarterly growth of real GDP. We got the sugar high from the tax breaks, and now look at the trend. I would anticipate that the first quarter, we might get a negative quarter. It'll be like this, right? One of these. The skip straight recession scenario, I think, is what we should be thinking about. I don't think we're going to get a financial crisis or 3 or 4 bad quarters in a row. But we're going to get the intermittent bad quarter, and then inventory has to catch up in the on-time economy, right? So the intermittent bad quarter is where we're headed in the short run. Payrolls missed. They'd already been trending down. So anybody not paying attention to what's been going on the last 3, 4, 5 quarters, because the stock market goes up and that's how they measure things, well, that's on you if you're not managing that risk. All the signs are there that this economy is going to turn over, slow down further, and at some point the stock market's going to follow it. Very simple. Economic growth is slowing down. The trade wars are directly impacting global growth. Corporations are holding back on investing. Hiring is flattening out. What does that sound like is coming? So somebody asks, is employment considered a lagging indicator and the market a leading indicator? No, the market is schizophrenic. Okay. The stock market doesn't tell you anything on a regular basis. It tells you something, but you have to figure out what it's telling you. Sometimes it's looking backwards like it is now. Sometimes it's looking forward. Sometimes it's not doing anything at all. It's just fighting with itself. It's just a product of animal spirits. So if you really want to buy value, you need an event to create value. There's very little value in the market right now. I've been saying that for a year. I'll show you a chart in just a second. What is the action plan to deal with economic slowdown? How many times have I told you to keep selling the rips? How many times have I told you to keep raising cash? If you make 5% or 10% this year, and then the market all of a sudden has a 30% down December, how would you feel about that? Because you're 60 or 70% in cash. Like I've been telling you, if you're a moderate or conservative investor, you should be working in that direction. If you're an aggressive investor and you want to trade a little bit, like I've told you about trading, you better be good at technicals or quantitative. And I show you some quantitative with the money flow, and I'll show you some more here in a second. And then I'm going to rip on a particular company and some analysis of it, because I think it fits in real well with the stupidity that has finally started to find its way into the market. The mania approach of some people. Now, the mania is not going to look like it has in the past because of all the deflationary pressure. So we have to somehow overlay in our mind, what does all the deflationary pressure mean to the typical mania that happens at the end of a bull market? Probably flattens it out. Maybe makes it jagged. Maybe creates a time period where instead of a spike up, you hover around the highs and just keep eking out new highs until you fall off a cliff. We'll look at some pretty pictures for that in a second. Employment is both a leading and lagging indicator as far as I'm concerned. It's lagging because it shows you what happened, but the trends show you what's coming. And the trend in employment is down. That means that what's coming is a worse economy. How does that all play into the stock market? We're at the third most overvalued period in stock market history. We get these little corrections that pulls us back. But we're supposed to be between the 50 and the 0. That's normal. We're way up here. And these are different measures of valuations. Our valuations are higher than right before the financial crisis. This is the product of a lot of easy money in the face of a slowing economy. Okay. If economic growth is slowing and stock valuations are high, then what is the likely result for the stocks in the short term? A couple years ago, in January of 2018, right before we made that first awesome VIX trade, and we'll talk about VIX because somebody asked me, I said 200-day moving average at the time looked like a pretty good support level. And I've pointed to this range here around 220 on the S&P and around 160 on the S&P as 165, 170 is spots where we have to pay attention. So how deep of a correction can we get? So in Q4 of 2018, the S&P 500 fell almost exactly to where I said it could in January of 2018. I said 250-ish, 255-ish, which is where his 200-day support was. Throwing 11 months, it got down to like 243, just under my target range. Okay. If we had a strong economy, we talk about support levels and bottom fishing. If we had a strong economy that was getting stronger, right? Rates of change matter. Rather than a strong economy that was getting weaker, if we had a strong economy that was getting stronger, or at least holding steady, like it was a year or two ago, but because of more deficit spending, right? That's what we got 2 years ago was deficit spending, tax cut, right? $1 trillion deficit. Then I'd say, well, then we probably will not go below this level, and we'd want to buy it in here. But I don't think that's true. I think with the weakening economy, this is the box that we need to be afraid of now. An S&P 500 in the low 200s, 230, 220, 210, 200, hard to know. With this box right here, there's a whole bunch of support levels in there. This is where I think big money will come in. Because they know that under President Warren, get used to saying that because it's going to happen, there's going to be a big change to the economy. It's going to get built from the bottom up rather than top down. Trickle-down economics will be hit in the face. In my opinion, that's a good thing, but there will be growing pains. So we'll probably get a pretty good year or so to buy in this box. So don't be impatient. And I've been getting emails. I actually got 5 emails this week. I never get 5 emails from people asking about why aren't we making more money. Well, these same people last December wanted to know why we weren't, why we were losing money. Same people. They want to buy and be fully invested when things are going up, and they want to be protected when things are going down. And I get that. But you can't be protected and be 100% in stocks. Can't be done. If you believe that things are going to get worse, and this is what Bob Savage mentioned to me in New York earlier in the year, sell. You don't have to be perfect on the timing. So my ex-landlord, who was kind of a jagbag at the end, raising my rent hugely the last 2 months I lived there, and I offered to buy the building, is selling the building, but he's asking for $80,000 more than I was going to offer. So I get that. He's a seller. He's a guy who's a buy and hold real estate investor, selling almost all of his properties right now. I know other real estate investors doing the same thing. I've told you that as driving across the country, I saw more and more for lease signs and more for sale signs. I go to the same places. I have been for 15 years. I look at the same places over and over again. So You need to get out of your head, if it's in your head, that you want to be aggressively buying anything. There's almost nothing that I would buy at a bull market support level, because I think this bull market is just about done. Could we get one more little rally here this year? Good Santa Claus rally, good January effect rally? Absolutely. If you want to try to trade that by buying now and selling later, that's fine. But I don't think most people are really 60, 70% in cash yet. You should be looking to get to those levels on the rallies. Does your outlook look the same with Trump win? No. If President Trump wins, we probably actually get the financial crisis early. He's about 1% to be president again at this point. If you're a gambler and you understand odds, given what's going on right now, President Trump is probably 1/10 as likely to win next time as he was last time. And he had to thread the needle of God to win last time. So if President Trump is president again, then you'll see this. Because he's doing everything that President Bush did, GW, who I actually think is a good man at least. But those trickle-down policies, the tax cuts to the rich, the deficit spending, they don't really trickle down to everybody. They inflate asset prices. They create spike opportunities to sell. They provide crashes for people who understand that to buy. But almost everybody else is a chaser. There's very few people who truly buy down here and sell up here. Look at this choppiness. Is this indicative of a huge bull market? Does it look like this? Does what's gone on in the last 2 years look like this? It either looks like this or it looks like this and this. So I'll give you some examples. What does this look like? When is this time period? Do you know? If you're thinking, you're looking over here. Choppy period. This is what happened next. See the highlighted period on the chart? Did you buy in the circle? What about down there? Did you buy in the financial crisis in 2009? This is a historically long bull market. Take a look at this. What does that look like? Go back. Looks a lot like that, doesn't it? So I have said over and over again that I don't expect a financial crisis next year. I expect a skip straight recession or a mini recession. Very similar to what happened in 2000, 2001 too, right? It's just kind of a weak period. There's a lot of liquidity out there, but there's a lack of trust and there's an economic slowdown. Asset prices are starting to jitterbug. They've been doing it for about 2 years. The stock market, people want to say, keeps setting highs, but just barely, by a point or two, and then it comes back, and then a point or two. So over the last 2 years, depending on where you measure from, right, top to top, people want to measure from bottom to top. Oh, look at that gain. Measure from top to top. Then take a look at where the bottom was in December of last year. Now, it's not unreasonable to think we get back there. I think it's very reasonable to think that we go significantly lower into that 220, 230 range on the S&P 500. Interestingly, a half a dozen other analysts that I know, we've all come up with the same answer, and none of us were working together at the time. Now I work with Avi Gilbert a bit. He's been saying 220, 230 on the S&P 500 for a couple of years. He said, I don't know how it'll get there, but it'll get there. and then it'll rally. Right. After a crash, there's a rally. After a rally, there's a crash. Market typically goes up about 2/3 of the time. We've had very little downtime in the last decade. A couple little mini corrections. I urge you to manage your risk levels. If you can't stomach a 30, 40% drop in the stock market that takes down an awful lot of things 50, 60, 70%, like you've seen in oil, then you need to think about how your asset allocation should look. In our asset allocations, even the aggressive investors are, 25, 30% cash. Now, I like cash. It's very rare that I don't have 10% cash. Why? Because every now and then you get an elevator drop on something, sometimes everything, but usually you can expect one of the stocks that you never thought would take an earnings hit, they have a really bad quarter. And then you get a few months to buy it after it settles off and the negative emotions, right, stop driving the price. Sentiment stabilizes. Fundamentals using that time period catch up and repair. So you get opportunities. Patiently wait for the opportunities. I beg you. What happened to oil could happen to a lot of other places soon. I think people in REITs are in big trouble. I think you're going to see 20 and 30% drops in REITs and a lot of dividends, especially in the commercial and retail REITs, are going to stall out on their growth for a very long time, for 4, 5, 6, 7 years. So that 5 and 6 and 7 and 10% dividend growth ain't going to be there in the future. And you're going to have principal 20 and 30 and maybe 40 and 50% losses that has to be made back. You should be selling your REITs into strength like these landlords and property owners I know. Stop looking in the rearview mirror. Speaking of rearview mirrors, so I very rarely point out other authors, but I'm just irritated about this whole Altria outlook. So Dividend Sensei here, who has a great track record, but he's what I would call a bull market manager. He's what my brother and I would call a bull market manager, meaning they happen to be in the right place at the right time. He's got 3 of his stocks and 3 holdings. None of them are bad companies. AbbVie is a good company, but they have a major problem with their leading product, and it's not going to get fixed quickly. I understand AbbVie, right? I'm right down the road. I know people who work there. They got a big problem with their big revenue generator. Why? Because they cured a disease rather than treated it. Right? They cured a disease, and it was their big revenue generator. So that's the problem, right? The complaint with pharma was that they just treated things; they didn't cure things. So AbbVie went out and cured something. Now they're screwed on revenue. Brookfield Property. Now, I like Brookfield Asset Management, not Brookfield Property. And there's a reason for that. Think about the MLP structures that are out there. People are glomming onto the dividend here, but the reality is that the parent company is the better deal. Then Altria. I save most of my vitriol for Altria. There's people in 3 stocks, 28% of his net worth. And none of these are what I would call value stocks. They all have significant headwinds to their businesses. All 3 of them. That's a lot of risk The risk is not being taken seriously. And when you take a look at some of the comments that are down here, all I can say is bag holders. You're going to get a lot of people who point the finger in another direction when they lose 20 or 30 or 40 or 50% of their money. Altria's growth story. Let me see if I can think of a word. What word might I use for the Altria growth story? Come on. I said it once already today. It's what? The Altria growth story is bullshit. There is no Altria growth story. They're hanging on by their fingernails. Two years ago, I told everybody to sell Altria. And the same people were giving me crap in the comment section. 2 years later, Altria is down 40%. What does this chart look like? Oh, it's a value. Oh, no, it's not. It's a value. No, it's not. It's a value. No, it's not. They're saying the same damn thing now. I will bet anybody a pack of cigarettes that Altria gets into the 20s in the next few years. How's your dividend then? Well, if you take a look at the multi-chart here, scroll down to the bottom. Why does a PE ratio come down, 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 down? What's the answer? It's because there's no trust in the earnings going up. There's less growth. I mean, unless there was a market event. Now, a market event can pull PE ratio down of everything. But why does this just drift down over a decade? No growth. They tried to buy people back with a big spike in the dividend. And what did that come with? Big spike in debt. Two investments that were very poorly thought out. So you have this guy with what, 20,000 followers? That's not what I wanted. Dividend King's my ass. 60,000 followers. It's an awful lot of people in a lot of his stocks are going to be hurting for certain when this market turns over because they are not accounting for risk. Stop chasing returns, manage your risk. Who does that sound like? Some guy in Omaha that's done all right, right? Analyze the businesses. Altria's debt doubled. Why? Well, this kid's got it figured out. This kid with 105 followers completely nails the risk at Altria. Right? Can Altria repay its debt? They invested in Juul, which has the government coming after vaping now. And they invested in Kronos, which is marijuana, Canadian marijuana. And now there is a surplus of marijuana on the planet so big that we couldn't smoke it in 5 years if we stopped growing marijuana. Did you know that? There is no shortage of marijuana. So for Altria to grow, they have to get more revenue and higher margins. How are they going to do that with a surplus of marijuana? How are they going to do that with smoking dying a slow death? How are they going to do that with vaping hitting a brick wall? Well, their management, they just replaced their CEO. Well, in the past, tell me about 30 years ago. How great was it then? What is it today? Well, back then, you know what? Stop it. There's a whole disclaimer on every investment package out there. Past performance is no guarantee of future returns. If you're in Altria, you're a sucker. You were a sucker back here 2 years ago when I told you to sell it. And granted, I know people on this call aren't all in this, but there will be people who watch this on YouTube. And I'm going to write another article about Altria. Kronos. How's that curve look? Right? Looks pretty hyperactive to me, huh? So this stock went from $1 to 24 in 2 years. All these people up here buying. And it'll come back, it'll come back, it'll come back, it'll come back. It's not coming back, folks. I told you the only way to make money in marijuana is with a really good product. So let's go back to the very beginning. MSCI World Index versus earnings per share. What have we talked about in the past with alligator jaws? Stock prices going up, and the MSCI World Index is 60% United States. So the index is going up, earnings falling off a cliff. Happened here. Bam. If you go back, I wish they had a longer chart here. You'll see that almost every time there's alligator jaws, like here, you get a crash. 20-some odd % there in 2015. Now, take a look at this. These are much bigger alligator jaws, aren't they? That 220 level-ish and the S&P 500 is looking pretty serious. How serious? Well, let's annotate this a little bit. When these alligator jaws closed, you got a 20% decline in that index. This might be a support level. Hit it twice. All right, resistance becomes support. Boom, boom, boom. So for sure, we probably get down to this level. But what if this looks like this? We have about a year and a half before we get any meaningful stimulus or fiscal reforms or a central bank that finally throws in the towel and says, fine, we're going to do QE. We've got all of next year could be a pretty significant bear market. So from here to here, right, 300-ish, down to 200-ish. This suggests it could be a little lower at the international level, which is why we're not particularly invested internationally. So what do we want to do if we get in between these yellow lines? Look for where the growth is. Where's the long-term growth? Is it China or is it India? You know what I think? Is it Vietnam and Malaysia, or is it, I don't know, France and Germany? Maybe a little of them, but probably not. Europe's got problems that are going to last a very long time. Young, educated, not struggling for resources, technologically inclined, that's what you're looking for. Apologize if I sound a little irritated. I am a little irritated. Oops, didn't mean to do that. So I'll just show you the MSCI index here. Right? It is 63% US. And they had a little outtake chart. Emerging markets have actually done a little bit better than the developed markets, but with a lot more volatility. During a correction, yay, poker stars. During a correction, I think we probably really want to expand our emerging markets holdings, right? Go to GMO. All right, so GMO is a big-time money manager. Jeremy Grantham worked here. If you can, sign up, read their letters. They've changed things. I don't know if I can still log in. I don't know. I might have to do it over. But GMO has some pretty good charts. And they talk about how emerging markets probably have almost double the economic growth of the developed markets in the future. But you can pull the United States out. The United States growth rate will be between the emerging markets and the rest of the developed markets. Why? Because Japan and Europe have long-term perpetual problems. The only thing that's going to break the world out of this economic growth slump is 3 decades of trudging along and letting old people die, or not Alexandria Ocasio-Cortez's Green New Deal, but some sort of Green New Deal. And I say that not to be political, but to tell you that there needs to be an awful lot of development of the energy and water infrastructures on the planet. It's going to happen either quickly or slowly. Quickly would be better, regardless of what you think about climate change. California is doing rolling blackouts because their grid is so bad. It's happened in Ohio. It's happened in other places all over the world. So if we can figure out a way to rebuild all the necessary infrastructure we need on the planet without bankrupting ourselves, right? That's the trick. Without causing hyperinflation, then that's what we have to do. I think there's a way to do it. We'll see if the politicians figure it out. Because everybody's afraid of something, and some asshole is always going to say what he needs to say to get elected. So it's up to us to figure out what's good for us. What's truly good for us. Is trickle-down economics truly good for us? Is coal and oil and gas for the long term truly good for us? Or is adapting to change, which is perpetual, right? Change is a constant. And saying, you know, maybe it would be better if we had a more reliable grid and stored energy. Maybe it'd be better if we had water. Maybe we should recharge the aquifers. Maybe we should figure out a way to use the seawater for energy and for water, for fresh water. Maybe we should figure out ways to do all that stuff. Maybe we should figure out how to deal with healthcare. Not rehashing some old way that didn't work. So, let's take a couple of questions here. Okay, somebody asks, as an alternative to raising cash, do you have a suggestion for put buying as a hedge? No. No. You cannot hedge well enough and cheaply enough to win if you don't have a big stockpile of cash. It cannot be done. I'm telling you, 25 years of experience. You would have to catch lightning in a bottle. You'd have to get lucky. That's what Bob Savage, who was running track research, and now he's running FX, I think, over at Barclays. And he's a big-time guy. gave a presentation that people were bored with because everybody wanted to talk about cryptocurrency and weed and option trading. And futures trading seems to be the big thing now. Get every little kid out there trying to trade currencies that they don't understand. You know, trying to hit a home run trade. Well, I tell you, as a poker guy, the players out there that play all the big hands, they get into every bet. It doesn't matter that they hit a big trade once in a while because their chip stack is below half. All they get to do is get back to even. So, no. Could we get a good VIX trade at some point? We could. We've had 2 of them in the last 18 months, 19 months, right? So the key to the VIX trade is actually look at VIX, at volatility. So volatility is 13.79 right now. The 2 times we made this trade, it was under 10, and it was under 12. So don't look at the instrument because the ETN VXX has time decay. So somebody said, well, it's at a 52-week low. If you adjust it for time decay, it's not. It's equivalent to this. So if the VIX, the actual VIX, wasn't at a 52-week low, then adjusted for time decay, the VXX wasn't either. Right? Because they're supposed to mirror each other, but they don't because the VXX has to roll their futures every month and it eventually decays. So they had to start a whole new VXX over here because it eventually just whittled away to nothing. And then it spiked right away when they got the new one. This is a repricing. It's really a whole new series. Don't have too much time to talk about it, but these don't move in perfect tandem. Look how the lines gradually diverge. So they're going to have to reprice this eventually again when it keeps drifting down. So actual volatility. Now, this might be a better trade than I think. What if volatility doesn't go for 3 months and you have a 2-month call? I think you can do an unleveraged trade here by selling some $12 puts if there's any premium in there, right? So I don't know what the price is. Oops, that's not what I'm looking for. Option chains. So find a symbol VXX. Got it. Oh, they've made this website harder to use lately. Oh, whatever. Take a look at here. So should we go to the old standby? Let's go back to the old standby. Market's down today. Yahoo's way easier to use than NASDAQ. Isn't that silly? So, say you want to sell a November put. We know this. How low can this go? So let's say this goes down to 12. What would this go down to? It's hard to tell, right? But for sure, right now the prices are even though the VIX is higher. So that's about a 1/7 difference. So 18. I do math in my head funny. But I'd say 18-ish is the put that I'd be looking to sell. But there's no premium in it yet. You still need it to fall quite a bit. So careful with your hedging. Could you buy S&P 500 puts? Sure. I think that's probably a better option rather than selling VIX puts or buying VIX calls. Could you buy an S&P 500 put? Now, these are short duration, so you want to go out to, let's just go out to January 2021. Now, these are going to be pretty expensive, right? Because there's a lot of time value in there. The problem with hedging is you have to be precise. Otherwise, you pay a lot for time value. You look at that, you're paying $20 just to go down 6-7%. There's not good ways to hedge unless you can really catch the trade in an on-time way. And there's no way to catch these trades in an on-time way unless you get a nearly perfect setup that allows you to take that chance. Because most of us, most of you, right, this is margin of safety investing in fundamental trends, really can't handle that kind of risk. People are all spazzed out about the oil trade. They lost half of their money on a quarter of their portfolio, so it should be down, 15%. And they want to know from week to week if Antero's outlook has changed. What? Or Chesapeake. No, the outlooks aren't changing. They all need oil and gas prices to go up. I've said that probably doesn't happen until after the election, although maybe it starts in the spring. So do you trade those? Do you sell them at the bottom? No, you just wait. You let the calendar fix it. So be careful with your hedging. Cash is better. Patience and cash is way safer than trying to make a hero trade. If you're one of the poker players in the group, right? Are you going to make a hero call on the river? No, try to win the hand before the river. Every now and then you have to make a hero call. If you don't, in investing, you don't have to though, right? You get unlimited pitches. Mixing our metaphors. So TLT is going to work until it doesn't. We should have bought it before. I don't know where it is right now. Yeah. It's probably not a horrible trade on these dips. So we're probably going to get lower rates eventually, even lower at the long end. I think that we have to. Until they make noises about helicopter money and fiscal policy, right? As soon as fiscal policy kicks in, this goes down hard. So while we're on the monetary train, I guess you could probably buy the dips. As soon as the fiscal train takes off, gets on the track, then this is going to fall back into this region, right? Then it falls all the way back down here. And there isn't a ton of upside here. There's not. There's just not a ton of upside. So I haven't been using TLT. I wish I had bought it along this line, and I didn't. So would I buy it up here? Nah, it doesn't offer the risk reward that I'm looking for. I think we missed that one. I mentioned Marin. So Marin's in the right industry at the right time. We just have, we started buying it in here last year, 9 months, whatever it is. Early this year, we started buying it. I like this pattern. I thought this pattern was here. Oops, another level lower. They don't put out a lot of news, do they? You just have to listen to their earnings and read their quarterly reports. They have another one coming up in a couple weeks. So keep an eye on it. It's the right business. Given what's going on with digital content and advertising and privacy and trying to measure metrics, I think that these guys are in the right place at the right time. I just think you gotta be patient. When I say patient, I mean patient. Right? I was investing in this company here. All in here. Selling puts, getting them assigned to me, buying shares. Took a very long time, years, to make a big return. So from $2, $30, sold it, started buying it, got shit kicked out of me, bought a ton more than I sold in here. And I'm a knucklehead because I could have gone all the way to there. Oh well. But, you know, I made an awful lot of money on that. You don't have to find a lot of these. Wait for these better pitches. You know, when you know something's going to happen. I thought these guys would just get bought out at 10 or 20 bucks a share. And they got a CEO that doesn't want to sell. And he set up the company that way. For Exact Sciences to get bought out, somebody would have to write a monumental check. Now, I will say this. Exact Sciences is one of 6 biotech companies I'm going to put on our list imminently. 4 of the companies are gene editing companies. 2 of the companies are diagnostic companies. And Dave Zanoni, I didn't know that he was doing this because I don't tell Dave and Ted what to do as far as specific companies or what to think. I say, look, let's go, let's find some things over here. Well, Dave Zanoni just did the articles, the SWOT analysis, and then an investment thesis on Bristol Myers. Bristol Myers is one of the companies that I happen to have picked out on my own as well. So now we'll compare notes. And I tell you what, I like the Bristol Myers Celgene merger. And so for dividend investors, I think Bristol Myers is a company that should be on your radar, right? It's gotten a really nice pullback, you know, from 74 into the 50s, snuck into the 40s. And I think on a stock market correction, you can see a price in this area, right? And, you know, color that in. So a sub 40 price on Bristol Myers for a hot minute is probably going to happen. I have a couple limit orders set at 40. And maybe it should be lower. Maybe it should be about here. Maybe it should be low 30s, 33, 34. So I'm going to work on this. But Bristol Myers is a company that I like. I think the Celgene acquisition was smart. I think for dividend investors, you know, it's not a huge dividend, but it's higher than the market. And their growth rates are going to be higher than the market too. So you get an above average growth rate, an above average dividend, you know, and I think they're headed in the right direction for that industry. I don't know. You know, I've told you I wasn't so sure we get a fake trade deal with China. The Chinese are outmaneuvering President Trump at every turn. They bought what they needed to buy, and now they need a little bit more. But, I mean, they're only 15 months out from being able to deal with somebody else. So, I think they might just put the nail in the coffin and not do a deal. Unless they get exactly what they want. So we'll see. I think that you're going to be able to get to follow President Trump in the media with his brand new media company that they opened starting in January of 2021. So is Bristol Myers on the list yet? No, I'm going to add it. I'll get it done this weekend. I have, and I can't show it to you because I don't have a camera, but I have a whole whiteboard broken up into groups, very similar to how ARK Investments does it. So I've got a bunch of top lists. So top dividend stocks, top biotech growth stocks, top alternative energy stocks. And I think that will help us find our opportunities a little bit more efficiently as they become available. Also, I've got a whole bunch of ETF articles that are outlined. TAN is one that you're going to want to buy on a pullback. You know, we talked about this quite a while ago. They used to have a very large China component, and they've whittled it away. I don't know that we'll get all the way back down here, down to 20, but 24-ish. I think you probably want to add 10. Keep in mind what the market's doing at the time. Yeah, those will all be A lists, but I've shortened the very short list. Those are very short lists already. So any of the 60 companies, 70 companies in dividend growth and in sustainable growth, they're all good companies. And there's not really a way to rank order them. They're in that top tier. So anyway, TAN, for those of you who don't necessarily want to pick out First Solar and Solar Edge and Enphase, Sunrun, which they have a nice deal going with Costco right now, and then some international components. I think this is a pretty good fund as it's structured right now. So this is one that I think we should really pay attention to. It even has a yield. What's the yield here? About 1%? No, about 0.5%. So not too sexy. But think about shareholder yield over dividend yield, right? Total return is what you're looking for. So companies that reduce debt, buy back shares, and increase dividends are all worthwhile. Shareholder yields over 10%, or projected to go over 10% because of their growth rates, that's nice. And what you want is companies that are accelerating growth, not decelerating growth. We talked about that with the economy in general. So rates of change matter. 30 years ago doesn't matter. I guess that's what I'll leave you with. I like TAN better as a pure play than ICLN. ICLN, though, if you want something more diversified. Yeah, I think you're going to see a shock to the system at some point with these negative interest rates. Helicopter money is inevitable. Keep saying it. Helicopter money is inevitable. Yeah, right. Once a bear market starts, you can buy a bear ETF, but I wouldn't speculate on it until the bear market begins. So the support level on the S&P 500 is right around 940. Keep 940, 2940. So let's take a quick look here. If we break, see where this is? It keeps getting down into this level here, 290-ish. We go through that. There's a long way down. So right in here, 294 to 285. That's your warning. So your light should go off. Comes down through here. You should be a seller. And once it breaks through a little bit below that, right? This is a pretty strong support level. This held. I don't think it'll hold again, but it might. Especially if we get through here. We'll see that. And then you have all sorts of places you can get to. Right? We've looked at that already. So once the bear market begins, yeah, go ahead and buy a short ETF. I'll have a couple of those on board. I probably won't use any leverage. It'll just be straight inverse. Probably won't be any 2 or 3 to 1s because those snapback reversals hurt a lot. And you could wake up with the market up 3%, and then you're down 9% on one of those leverage deals. So no leverage, but if you want to do an inverse after it already begins, if you have that type of risk tolerance, I get it. Most people should just hold cash and wait for the buying opportunity on the bottom, because 2/3 of the time the market goes up. All right, have a great weekend. I'm going to China Lights on Sunday. All right, have a good weekend.